Welcome back to a special edition of Daily Dose of AI, your guide to the technology shaping our future. Today, we're replacing our usual format for a deep dive into the most critical question on Wall Street and in Silicon Valley. Are we in an AI bubble? We're treating this as a true Market Watch special. It's a complex topic, so we'll be going longer than usual to make sure we break down the history, the arguments, and the real stakes for the global economy. Part 1. What exactly is a financial bubble? The greater fool theory. Before we talk about AI, we need to define the term bubble. It's a great analogy, but what does it mean in financial terms? Imagine a beautiful balloon. The air inside it represents the company's intrinsic value, the actual profit, customers, and tangible assets it holds. A financial bubble is when the price you pay for that company, the market price, gets inflated with hot air, pushing it far, far away from that intrinsic value. The reason people keep paying the inflated price is the greater fool theory. It's the belief that no matter how much you pay, there will always be a greater fool tomorrow who will pay even more. This works until the market runs out of fools, someone panics, and the selling starts. When the air runs out, the balloon doesn't just deflate slowly, it bursts. Part 2. The original tech bubble, the dot-com crash 1995-2000. To understand the AI situation, we must look at the dot-com bubble, which peaked around the year 2000. The context. The internet was a truly transformative displacement technology, just like AI is today. Everyone knew it was the future. The problem, hype over profit. Investors poured billions into any company with a .com after its name. It didn't matter if the company had a business plan, a single paying customer, or even a way to make money. The disconnect. You had companies valued at billions of dollars that were reporting zero profit or even negative profit. People believed a new economy meant that old rules about profit didn't apply. The burst. In March 2000, reality set in. The U.S. Federal Reserve raised interest rates, making it harder for these unprofitable companies to borrow money. Investors suddenly demanded to see profits. When the profits weren't there, the selling began. The tech-heavy Nasdaq index fell by nearly 77% over the next 2.5 years. Thousands of companies vanished, and millions of investors lost their fortunes. Part 3. The case for the AI bubble, the red flags. Now, let's apply these lessons to the AI sector today. The AI market, led by companies like Nvidia, OpenAI, and a wave of new startups, shows several classic bubble warning signs. 1. Sky-high valuations. Nvidia's valuation has skyrocketed, with its stock price based on the assumption of near-perfect exponential growth for years to come. Startups are being valued at hundreds of billions of dollars after just a few years, sometimes before they found a profitable, large-scale customer base. 2. The return on investment disconnect. Companies are spending massive amounts of money, billions, on AI infrastructure. This is the input. However, the actual output, the tangible, measurable productivity gains and profits from using that AI, has not fully materialized across the economy yet. This gap between the massive capital expenditure and the current proven return is the biggest concern. 3. Circular financing. VC funding in AI has exploded, far surpassing .com levels in absolute terms. Critics suggest much of this money is cycling between investors, startups, cloud providers, and chip makers, creating an illusion of a widespread activity that is heavily concentrated at the top. Part 4. The case against the AI bubble, the defense. The believers, the AI bulls, argue this time is fundamentally different. They say comparing it to the .com era is a mistake. 1. Real, tangible assets. Unlike the .com era, today's AI leaders, like Nvidia, Microsoft, and Google, are producing and selling tangible, critical hardware and essential infrastructure, like cloud services. These companies have massive profits and cash flows right now, not just promises of future profits. 2. Big tech is driving it. The major investors are not small, reckless startups, but the world's most profitable companies: Alphabet, Microsoft, Meta, and Amazon. They're funding AI development internally using their own massive profits, making the system more resilient to external shocks than the debt-fueled startups of 2000. 3. Proven productivity gains. While the full economic impact is still coming, AI is already demonstrating clear productivity gains in coding, drug discovery, and customer service. The transformation is already starting to happen, not just promised for some distant future. Conclusion: correction or collapse. Most experts agree it is highly unlikely to be an immediate, catastrophic burst like the 2000 crash. The AI market is backed by too much cash and too much foundational technology. However, a correction, where prices fall significantly, is very possible. The key takeaway is this: this is an innovation boom, and booms always involve irrational exuberance. For investors, the challenge is separating the true, profitable disruptors, the next Amazon or Google, from the overhyped projects that will vanish. We are in a historic moment where real technology is meeting speculative hype. The question isn't if AI is valuable, but whether the price we are paying today is rational. How do you think?